Your first $100 is not mainly a stock-picking decision. It is a sequencing decision, because the right destination depends on your emergency cash. Debt cost, employer benefits, goal, and time horizon. The same $100 can provide emergency cash, reduce expensive debt, unlock an employer match, protect a near-term goal, or begin a long-term investment. Those jobs are not interchangeable. Use this order. Protect basic liquidity, check debt rates. Verify any employer match and its rules, define the goal. Then invest according to the goal's time horizon and your risk tolerance. Maya now has $3,200 in checking, $600 in emergency savings, a 24% credit card balance, a 6.5% car loan, an available employer match, and a car replacement goal 3 years away. Open cash flow and make sure the $100 is a repeatable monthly surplus. Not money needed for next week's rent, tax, insurance, or minimum payment. $600 is a useful start. But Maya drives to work and recently had a repair. Her starter buffer should reflect the emergencies she is most likely to face, not a generic number copied from someone else. On home, check how long accessible resources can cover essential outflow. A positive net worth does not guarantee that Maya can pay an urgent bill without borrowing. A 24% credit card rate is a difficult hurdle for any uncertain investment to beat. InvestorGov's preparedness checklist places high-interest debt before ordinary investing, although minimum payments and household needs still come first. An employer match may change the order, but only after Maya confirms eligibility. The match formula, contribution limits, and vesting rules. Never count a benefit she has not actually verified. Money needed in weeks should not be treated like retirement money needed in decades. Maya's 3-year car goal and long-term retirement account require different levels of liquidity, volatility, and risk. Use 3 conceptual buckets: safe, accessible cash for now, goal-aligned savings for money needed soon, and diversified long-term investing for distant goals. The exact products depend on country, account rules, fees, and personal risk. Return to balance and verify every asset and liability. This keeps the first $100 from being optimized in isolation, while a larger risk remains off-screen. Use project to label the car replacement, emergency reserve, retirement, or another goal. Once the purpose is visible, the correct horizon and constraints are much easier to discuss. In this specific scenario, Maya uses the first $100 to strengthen her starter buffer because liquidity is thin. The next repeatable 100 is compared with the card balance and any verified employer match. After the buffer is stronger and the card balance falls, Maya automates the monthly amount, captures verified employer benefits, separates the 3-year car goal, and invests only the money assigned to long-term objectives. A strong agent prompt includes the cash, both debts and rates, employer plan uncertainty, car goal, and the non-financial need for career flexibility. Ask for a comparison under several assumptions, not a single magical answer. Beginner safety matters more than excitement. Be skeptical of guaranteed high returns. Pressure to act now, unregistered sellers, and investments you cannot explain in plain language. Scroll through the account rows, verify custodians, balances, projects, and liabilities. Then return to the summary. The $100 decision should fit the whole map. The first $100 matters most when it becomes a policy. Each month, recheck the buffer, debt rates, goal dates, and the next automated amount before choosing an investment. Do not ask only what to buy. Ask what job this money must do, when you need it, and what could go wrong. Next, we will build a beginner portfolio map without turning the market into a casino.